Good evening. Welcome to the webinar on Introduction to Investment Planning. Now, to begin with, one needs to understand what is investment planning. Right? Investment planning simply means buying and selling securities in order to earn a rate of return which far exceeds the risk-free rate of return. Right? Now, when I say securities, now what do you mean by securities? Now, securities simply means that any document or any kind of a security that gives you the right to receive a certain amount of either in terms of principal payments or in terms of interest or dividends, some sort of financial return on your investment. Any particular investment that gives you some sort of a return on that is categorized as a security. Now, specifically when you talk about the security, now any security in terms of the rate of return, we can represent it in this form: Pt minus Pt minus 1 plus divided by P0. Right? Now, to take an example, suppose you buy a particular security for, let's say, 100 rupees, right, at the beginning, and at the end of the period of whatever holding period, and let's say the price of the security goes up to 105. But during the course of your holding period, let us assume that you received another, interest or dividend of, let's say, rupees 5. So in that case, your returns become 105, that is the end of the holding price, minus the price that you bought it for, plus, let's say you received an interest of rupees 5, divided by 100, right? So you've got 10 upon 100, right? That is a 10% return on your investment. Now, if you look at this particular equation, now this is actually the sum total of capital appreciation plus the regular investment or the regular return that you have received, right? Now, when I say capital appreciation simply means, right, the change in the price of the security, whereas any regular income that you get can be categorized either as dividends or interest, which means some specific periodic return on your investment, a regular income that you receive on your investment. Now, if you look at this dividend or interest, now see, dividend is usually categorized in terms of equity investment, whereas in terms of interest you are looking in terms of fixed income securities. Now, when I say dividends and I say in terms of equity investment, what I am talking about is variable investment. Right? When I am talking about interest, it is called as fixed investment. Typically, you can divide securities into two categories: equity and fixed income. When I say equity, it means variable investment. When I say fixed interest or means fixed investment, it specifically means that you are talking about debt securities. Now, when I say variable investment, which means that the rate of return which you get on your equity is more variable rather than that on fixed income securities, which is more direct and which is more definite. Now, for example, let's say you buy a bond or a debenture, right? So you know the price at which you bought it for, you possibly will know the price at which you will be able to sell it for, and you will receive a periodic interest which will be fixed and demarcated well in advance. Whereas in equity, right, you do not know exactly the price at which you will be able to sell it for, because simply the price of that security will change in accordance with the market forces. Similarly, the dividends that one will get will depend on the performance of the company in the market environment. So if the company does well, it has earns profits, then in that case it is in a situation to give you dividends. Now, how much dividends it will give you, whether or not it will give you dividends, will depend actually on the performance of the company. Right? So now, if I actually would like to divide the range of investment opportunities that you have, now you can divide it into, let's say, money market securities and capital market securities. When I say money market securities, those securities which have a maturity period of less than 1 year, and capital market securities are those which have a maturity period of more than 1 year. When I say money market securities, we are typically referring to securities like treasury bills, money market mutual funds, certificates of deposit, commercial paper, intercorporate deposits. We are talking about gilded funds, government securities in terms of like treasury bills, repos, And when I talk about capital market securities, then I am talking about, let's say, equity, preference shares, bonds and debentures, other loans, term loans, etc., which have a maturity period of more than 1 year. Now, of course, within the capital market securities, again, as we had earlier said, that we can divide it into in terms of fixed income, right, which is in terms of debt securities, and variable, which is mostly equity. Now, preference shares would come somewhere in between equity and debt. Nowadays, even in terms of fixed income securities, you also have something called hybrid securities, which basically have some characteristics of both equity and debt. So, for example, you may have floating rate bonds, you may have bonds which are linked to some particular index. So, to some extent, even fixed income securities are not exactly what you would say as fixed income. Now, for example, if I want to divide fixed income securities, now you could have something like, floating or fixed, which means fixed means in the sense that the rate of interest is fixed, whereas floating is that the interest rate periodically changes. Then you have registered and unregistered, which means registered means that they have to be registered, whereas unregistered means that it can be simply transferred, in terms of a simple book kind of an entry, and it is not registered in the company's account. So anyone who presents and comes with a piece of paper that now I am the holder of the bond, so the whoever is the holder, the company gives the interest to them. Then there are convertible and non-convertible or partially convertible, which means that when I say non-convertible, which means it remains a debt security till the end of its tenure, and there is a fixed maturity period for it. Whereas partially convertible means that part of the fixed income security is convertible into other forms of securities, which may be either equity shares or preference shares, or fully convertible means that entire value of the bond is to be converted into equity shares or preference shares, depending on whatever is the terms of issues, and the ratio of conversion is actually fixed. Then you have something like zero coupon bonds, which is basically that there are it doesn't give you any interest, periodic interest, but it is sold at a discounted price, and at maturity it is sold at its par value. Then there could be variations in terms of how frequently the interest is paid. For example, it could be monthly, it could be semi-annually, it could be annually. So depending on that, you may have variations with regard to how frequently the interest is paid. Now, equity is otherwise in the sense that the nature of the equity instrument is such that it is gives you returns either in terms of capital appreciation or in terms of dividends. But even in terms of equity, there is some sort of a categorizations one can do. For example, you may have large cap stocks, you may have mid cap, you may have small cap, you may have cyclical stocks, you may have value stocks, you may have growth stocks, you may have speculative stocks. So now, depending on the characteristics, right, you can also divide equity into certain sort of categories. Now, for example, when I say large cap, large cap obviously means that those particular stocks which have a large market capitalization. And when I say market capitalization, simply means number of shares into the price of the stock. Similarly, mid-cap stocks are those which have mid-cap capital, which have a capitalization of let's say maybe 500 crores or something of that sort. Whereas small cap are something as those which is between 100 to 100 or less than 200 crores is the market capitalization. Value stocks are those which give you value over a long period of time. Growth stocks which are expected to show huge amount of growth. Speculative are those which the price will vary quite a bit. There is speculative gains to be got out of those stocks. Whereas cyclical stocks are those which will do well during cyclical upturns, and they are which will not do too well when the economy goes through a downswing. Right? Now, there are other forms of securities which are, I would say, but they are in the sense of we call them non-securities simply because they are not linked to market forces. Now, for example, let's talk about post office savings deposits. Let's talk about RBI savings bonds. Let's talk about PPF or EPF, right? That is Public Provident Fund and Employee Provident Fund. Now, these are particular stocks which are mostly government denominated, small saving instruments, mostly risk-free and default-free because the government guarantees them, and therefore their rates of interest do not depend on market forces, but it is dependent on the government. Right? Now, there are other forms of securities that have recently come up in the past, let's say, decade or in the last century or so, which are, for example, you have something like unit-linked insurance products, you have mutual funds, you have real estate investment trusts, you have art funds, you have gold funds, you have exchange traded funds. Now these are investment vehicles which invest in particular classes of assets. Now for example, mutual funds would invest in other securities in terms of equity or money market securities or debt products, whereas art funds would invest in art, right? Whereas real estate investment trust invest in real estate. Unit linked insurance products is a combination of insurance as well as investment. So it would give you an insurance in coverage, but will also invest in some sort of securities in terms of again equity or debt, depending on whatever categorization or whatever investment portfolio of the particular ULIP is, right? Now, on one class you have basically the variety of investment products, right? On the other hand, you have something in terms of that when you are looking at these investment products, you are basically looking at in terms of that what is the rate of return that you would like on them, and you try and combine the return in terms of what is the risks that you have on them. Any particular security or any particular investment that you would like to make, one has to be very clear of the fact that you have to balance the risk and the return, right? So the more return that you want, the more risk that you would like to take. So as I was saying that whenever you are making an investment decision, one has to look at the fact is that what is the rate of return that you are getting on your investment, and what is the risk that is going to be prevalent from that investment. Now, for example, if I am going to invest in equity, now when I invest in equity, there is a certain amount of return that I would like, but one also needs to understand that equity is obviously more risky than, let's say, investing in a zero coupon bond or let's say in a treasury bill. So obviously if you are investing in equity, then in that case you would expect a higher rate of return simply because the risk element in investing in equity is much higher. So if I am happy with, let's say, a 5% rate of return and let's say in a treasury bill for a period of 1 year, I may require at least maybe a 12 to 15% rate of return on an equity investment, because the rate of return on an investment is subject to more uncertainty. So therefore, it is very important whenever one is dealing with investments that to balance out the return and risk, right? Now, when you say return and risk, now how is it that the rate of return is balanced out with the risk, and how does one the prices of securities are fixed? Now, like any other commodity or any other thing that one may buy, now the prices of securities are also determined by the forces of demand and supply. Now, if let's say the demand for a particular security is high, then obviously the prices will down. Right? If, however, the demand for the commodity is low, then the price comes down. Similarly, it also depends on the number of sellers. So if there are more number of sellers, let's say in a down phase of the market, there are more number of sellers. So obviously, what happens is the price of the security will go down. So in all these situations, right, like for any other commodity that one purchases, right, the prices of securities are determined by the interaction of demand and supply forces, and the forces of demand and supply which influence the demand and supply are, depending on the market, will be different. Now, for example, if I am looking at fixed income securities, now interest rates will play a much bigger role than it would have played in, let's say, equity markets. So equity markets also, interest rates is a major governing factor, but the extent of importance of the interest rate in fixed income markets is far more than that in that of equity markets. So therefore, right, the interest rate is a major factor in terms of determining the prices of securities in a fixed income market, right? Now, if you are looking in terms of, devising your investment strategy, right, now for any particular client that would like to invest, now one has to be very clear about is that what is the purpose of your investment, right? Now, is it in terms of retirement? Is it in terms of building up a, in terms of a fund? Is it in terms of growing your portfolio? Is it in terms of making a huge amount of rate of return? So depending on the client's requirements. Now, for example, if a person is into retirement stage, now his possible route is to possibly get a regular income and to safeguard the principal. Right? Whereas somebody at a younger phase who wants to build up a portfolio is probably looking for higher rates of return and who would like to see the value of their portfolio increase. So in that case, the person would be looking at an investment portfolio which will give him a higher rate of growth, possibly may be willing to take more risk. Whereas a person in the retirement stage would possibly look for something which is safe and which would give him some regular income. So in that case, right, if I look at these two categories, then in that case the investment portfolio has to be structured in such a manner, whereas the person who wants regular income should invest in a portfolio of products which would give him that kind of thing. So in this case, probably invest more in debt, or if he has to invest in equity, probably invest in those stocks which are large cap and which should give him a large number of dividends. So the first stage is determine investment objectives, then find out which particular class of assets which will give him that kind of rate of return or fulfill the investment objective. Once you have determined the class of assets, then you pinpoint the particular securities. So for example, I am saying large cap stocks. Now in the large cap stocks, there is a universe of large cap stocks. So therefore, I have to pick up large cap stocks which will say that okay, maybe I may decide to buy Hindustan Lever, right? So Hindustan Lever, or I may decide to let's say invest in let's say TCS, right? So or let's say Reliance or IOC. So among these, let's say 4 or 5, I may choose to have only Hindustan Lever, right? So similarly in growth stocks, right? So depending on which growth stocks I would like to, there are vast number of options to choose from. So I will particularly select that class of asset. Now once I have done that, right, I will buy the securities, and once then I will determine the risk and return and find out the rate of return on the portfolio. Then in the next stage, I have to keep looking at the portfolio and evaluating it in terms of whether or not I am getting the desired objective or not, whether I am getting the desired rate of return or not, or whether the risk that is there on my portfolio, is it acceptable or not. And if in case it is not, then periodically I need to rebalance my portfolio. I may need to convert from equity to debt, debt to equity, or vice versa, or increase the coverage of equity, or increase the portion of debt securities, or possibly move into more classes of assets which have even lower amount of risk. For example, I may shift to gilt funds which are lower on the risk element, or keep more cash equivalent so as to reduce the risk on my portfolio. So depending on the objective that I have, right, I may need to keep rebalancing and realigning my portfolio. So the idea is that at each point of time, the investment is never static, right? I always need to reevaluate, reassess that whether or not the investment is in line with what I would like or not, and that is a process that will continue to be one has to make those choices, and that is what really investment planning is about.